To say it's been a challenging month of March for the interest rates and the bond market would be kind of an understatement. Since the war in Iran, we've seen oil prices increase, and every time that's done that, you've seen bond prices get worse, causing rates to get more expensive. Well, that trend is continuing today as the European Central Bank has hinted that they were going to start raising or hiking their version of the Fed funds rate. They haven't done it yet, but they just hinted at it, which is causing the bond markets to drop quite a bit. When that happens, rates get worse. Pair that with the war in Iran and the oil price surge, that's where you're starting to see some inflationary fears, which is causing rates to go up. Now you add in Fed Chairman Powell's comments from his press conference on Wednesday, where the Fed did not raise our Fed funds rate, but he just hinted that inflation is a little tougher to come down than they initially had thought. Bond market does not like that. Bond market does not like inflation. Now listen, before all the stuff with Iran came in, the bond market was doing well. The latest BLS jobs report, instead of showing 60,000 jobs created, which is what it was expecting, showed 90,000 jobs lost. The bond market should have been having a party and rates should have been going down even more. But an 11% spike in the oil prices in one day just kind of put a halt to that. We're just continuing to see that trend continue, and that worsening continues today. I wish I had better news on that, but we'll be watching this. Hopefully, as things start to come to an end in the Iran war, that you'll see oil prices come down. The last 5 conflicts we've seen over in that part of the world, oil prices have jumped up and then have come down, and rates have come down after the fact. So right now it's just a little rough. We'll keep watching this, but that's what's going on in the market.